morning, ladies and gentlemen, and welcome to our webinar, Odd Lot Bond Pricing After the Recent SEC Order. This is the first of our webinars for 2017, and it forms part of our Viva service. This is an independent valuation advice package targeted at US funds, both mutual and private. You can see more about this package by clicking on the icon in this slide, and it will be in the slide deck that you will receive at the conclusion of this live webinar. I'd first like to introduce myself. My name is Ian Blance. I'm the Managing Director of Voltaire Advisors. Voltaire Advisors is a specialist advisory and consulting company. We focus primarily on the valuation of assets and the pricing of portfolio constituents and holdings for the purposes of client reporting and for regulatory reporting, mostly by regulated funds, so those funds that are subject to some kind of regulatory oversight. We've been going for a number of years now. My experience goes a lot further than that, back into the evaluated pricing business, of which I used to run at both two of the major data vendors that exist in this marketplace. So to the agenda, we're going to run for about an hour today. Approximately 40 minutes of that will be a presentation that I have prepared to go through some of the issues today, and then at the end we will leave around about 15 minutes or so to take audience questions. The audience, by the way, can submit questions using the Q&A tool that's in the webinar software that you've loaded up today. So the questions will be written, and I will deal with those at the end as much as we can answer them. Another administrative note: the webinar will be recorded, and we will be sending you a copy of that recording again at the conclusion of the session, and this will allow you obviously to be able to review what has been said today in a bit more detail and at your leisure, and obviously means that you don't necessarily need to be taking huge amounts of notes in relation to today's webinar. We will also send you the slide deck, of course, so you can compare the two. So let's get started into the meat of the session today. I think the first thing that I'd like to do is to just to go over what the SEC order in December of last year actually stated. The first thing was that the order stated that during 2012, from February to June of that year, that PIMCO bought 156 odd lot non-agency MBS positions for its bond ETF, which was a new product at that time, at a discount, and then marked those odd lot positions, odd lot trades, according to the evaluated prices that it received from a vendor, which represented round lot positions, so institutional sized lot positions. And in 43 of these cases, according to the SEC order, the SEC adjudges that there was no reasonable basis that the firm had that the evaluated price actually reflected the possible exit price for these positions. So of the 156 positions that were examined, 43 of them were deemed to be valued at an incorrect level, at a level that was too high, and that this process led to a a material overstatement of the value of the bond ETF net asset value. You may, of course, ask, what about the other 113 issues that were examined? The order is explicit that it has nothing to say about these particular positions. So the order focuses on 43 cases where the Commission deems there to be no reasonable basis that the price allocated to that position reflected the fair value in that particular case. And the other thing that the other things that the order states is that that pricing policies and procedures at PIMCO did not address either these specific odd lot issues or odd lot pricing in the fund in general. It also states that the reporting of prices that did not reflect, was deemed not to reflect the market value of a position to either the pricing committee of the advisor or the valuation committee of the fund, that the responsibility for that lay with PIMCO's traders, and that those traders did not have sufficient oversight and or guidance on how they should actually perform that task. It also, the order also states that challenges to these traders from both the advisor's pricing group and the fund's administrator were dismissed, and in a particularly telling comment, it was revealed that because these exceptions, if you like, were causing operational difficulties for the advisor's process, that these challenges were eventually closed down. The automated generation of exceptions, which resulted in challenges, was eventually shut down. And finally, what the order states is that misleading reports were given to both investors in the ETF via the various different quarterly reports and the annual report, and to the ETF's Board of Trustees about the reasons for the outperformance of the bond ETF, particularly in relation to the actual the regular total return fund, which total return bond fund, and also the stated benchmark for those. So that's what the SEC order states. Let's look now at what one of the this is one of the quotes that comes directly from the SEC order, and I think it's pertinent to highlight this because it's important both for the order itself, but also for the implications of that order for for other funds, which we'll come on to at a later point in the presentation. So, what was undertaken by PIMCO as a result of this order? Well, the first thing that they were required to do was to engage an independent consultant to review, at their own expense, I should say, to review compliance policies and procedures in relation to the valuation of odd lot bonds, and with specific reference to two things. The first was in how evaluated pricing marks were deployed in this process, and this is outlined in paragraphs 30 to 34 of the order, for those of you who would like to read it. And the second is the aforementioned responsibility of the traders to highlight any pricing discrepancies to any control groups that occurred within the advisor or within the fund, so the pricing committee and the valuation committee. These procedures were outlined in paragraphs 39 to 40 of the order. So what this is clearly saying is that the SEC, when looking at this particular case, had concerns over how the pricing marks from a vendor were deployed in relation to other data that was being received by the firm, and also had concerns over who exactly was responsible for monitoring fair value and monitoring the value of the various different positions in question. So the second thing that that was undertaken by the firm was that they were required to implement any recommendations arising from this review within specified periods. All of the dates are in the order, unless they could reasonably object to what was actually recommended. And there is a procedure, an appeal and review procedure that's also outlined within the order for the firm to look at that. And the timings are relatively short. I think we're looking at probably within 6 months for the whole process to have been completed. And finally, certainly an undertaking that received quite a lot of attention at the time. The PIMCO agreed to pay nearly $20 million in a combination of civil penalty, disgorgement, and interest charges. So quite a slap on the wrist. I think it's also important here to look at the broader context of this particular case, because the original Wells letter identifying potential issues by the SEC at PIMCO came out in October 2014, and what is interesting here, I think, is that as it was reported at the time, the Commission were said to be looking at the total return funds, so the actual cash mutual fund, and not bond, not the ETF. And the way it was certainly reported in the press at the time, and we'll share some of that reporting with you in the write-up of and the supporting materials of this webinar. The way it was reported at the time was that the Commission was looking at the strategy of purchasing odd lots of specific CUSIPs at a discount, and then combining these odd lots of the same CUSIP, the same issue, into together to come up with what effectively would be an institutional size. So buy up the odd lots at discount until you have sufficient to make it up to a round institutional size lot, and then price it at that institutional round lot level. I remember looking at this at the time and thinking, oh, that's clever, because clearly the way that you could potentially do that would exploit the odd lot discount, the nature of discounted odd lots within the market, and then get a boost out of that in terms of pricing, because by combining all of those odd lots into a more marketable round lot size, it is, we believe, justifiably a higher price. It's almost like buying a beaten up old house, doing it up, and then selling it on at a much higher level. This behavior, although reported at the time as being what was being investigated, was not covered in the order, and we think that's because that kind of behavior, that kind of strategy, can be justified under the existing rules, and when it was considered, it would seem to be difficult to us to accuse any firm doing this as more, as being, as being other than clever, anything other than clever. Um, the other behavior that is not covered within this order is a firm's ability to buy a round lot at a discount to any evaluated pricing provider's mark, sometimes called superior execution. And this is something that we believe, by virtue of our own research and also intelligence that we've got from the marketplace, does actually happen quite a lot. Is that the ability for a firm to buy a specific issue or position at a level that is different from the round lot price that they're going to receive from their vendor is something that occurs quite frequently, certainly in certain sections of the market. This is not considered to be necessarily a breach of the rules. You could understand there may be lots of reasons why a specific firm, under the circumstances, is able to purchase a position at a discount. Maybe it's a fire sale by another shop. Maybe they they just are able to command a better a better deal from their broker or something like that. So this is not necessarily a big issue. However, and it's a big however, that the fund probably needs to beware that that when doing so, they need to be assured, and under the rules, the board needs to be have a comfort that the evaluated price that they are subsequently marking it at is considered to be a reasonable exit price, i.e., a reasonable fair value for that position, or the vendor mark should not be used. So exploiting the fact that a vendor mark might be incorrect, as opposed to you just happen to buy, execute a trade in a superior fashion, is something that a fund absolutely needs to be aware of. The rules here are very clear, and they were reiterated and restated as late as 2014 in the money market reform rules that came out that year, which I've linked to here in the slide. That the use of vendor pricing, the use of evaluated pricing for fixed income specifically, should be treated with caution, and that the vendor mark itself is not, in of its own, considered to be a fair value. The fund and its advisors needs to consider whether that price is appropriate and justifiable or not. If it is, and it happens to be higher than what you've been able to execute your trade at, then all is well. If, however, the price is incorrect, and the fund is obliged to check that, then you should not use it for the fair value of that particular position, or for that matter, any position you have under any circumstances. So that's there are a few exceptions there, and I think obviously it's important to know this, because we don't want to be throwing the baby out with the bathwater. We don't want to be rejecting the concept of any investment in odd lot bonds, just because of this particular specific order. And I think it's kind of summed up, if you like, by the SEC order itself, who explicitly state that they don't necessarily see it as improper to value an odd lot at a pricing vendor mark, depending on the circumstances. So they're not saying at all that it is incorrect to do that, or that an odd lot must always be valued at a discount from the vendor mark. It's just that in the circumstances, the fund needs to make sure that they cover all of they cover their specific circumstances in that respect. So moving on, what are the implications of this order for other funds? Well, as we mentioned earlier, we believe that certainly our own research and market intelligence we've gathered suggests that the use of various different types of what we would term an odd lot strategy is widespread in the industry. We described a number of the concepts in the earlier stages of the presentation. But it is out there, it is widespread, and therefore it is something that clearly applies beyond the confines of one ETF within one fund advisor. The other thing that's important to note here, given that it is widespread, is that we typically do not see the treatment of odd lot bond pricing taken into account in a fund's valuation policies and procedures. And I think that that this is clearly one of the major issues that that other funds will face. So we think the SEC order, whilst it was applied to a specific fund advisor and to a specific asset class within that fund advisor, that the strategy of odd lot pricing, the use of those kinds of positions within a fund needs to be addressed by all fund groups who invest in this kind of asset class. So it's not just PIMCO. The other key finding that we have that we draw from this, and obviously have discussed this quite widely within the industry, including with the Commission itself, is that the need to address this issue applies across all asset classes and isn't just specific to non-agency MBS. The order makes that very clear in the undertakings that it requires of PIMCO, and that is in paragraph 64 of the order, where they require an assessment of all the different asset classes that are invested in by the funds. So the most likely implication, the most likely result of this is that we could see an increase in operational complexity for some fixed income portfolios, certainly with depending on how much of this kind of investment activity goes on, certainly more exceptions, and potentially more references of investment scenarios to either the pricing committees of the advisor or to the valuation committees of the fund. What we would say too is that there is every possibility that that the Commission may conduct a sweep of fixed income bond funds, fixed income funds, as a result of this order. Obviously, as things stand at the moment, the Commission itself is changing its personnel, changing its leadership under the new administration. But the fact remains, I think, that this was a relatively high-profile order. Not only that, it was a relatively large fine, and those kind of things are something that I believe others would potentially be looked at if there was a suspicion at the SEC that this activity, that this behavior was more widespread within the industry. Even if this doesn't become an actual formal sweep, then we believe it will certainly be on the examination lists of anybody that comes in to assess a fixed income fund in the future. So what should funds be doing now? Well, the first thing is that we really strongly think that all funds where this kind of behavior may be relevant, which essentially is pretty much all fixed income funds, should urgently review their current valuations, written valuations, policies and procedures. We say written very strongly here because everything that we've had to do with the SEC over the last 20 years suggests that the Commission doesn't really consider anything that's not written down to actually be valid or to have actually happened. So it's all very well saying, making a statement that discussions were had with the pricing committee, or that that the traders were told what they should be doing to raise issues. If none of that is actually in a written form, then the Commission doesn't really give it any credence. However forcibly you may actually state that. So that's the number one thing, is that current written valuation policies and procedures should be reviewed. And if you haven't already covered it, then those policies and procedures should be rewritten to or addended and updated to explicitly address the valuation of odd lot positions. We would advise that even if you as an organization do not necessarily engage in very much odd lot trading activity, for whatever reason, we would advise that you should probably still have this concept, this issue addressed within the valuation policies and procedures. So the first thing I think probably to do is to review your current process. Having looked at obviously the written policies, if you like, then review the current process for identifying when a position, a position's prices do not represent the fair or exit value. And this is the prices that you receive either from your trading desk or even from a vendor. And this really applies even beyond the whole odd lot scenario, because the order was very explicit about its dissatisfaction, if you like, with the trading desks, with the trading desk being given responsibility for highlighting when a position departs from its true fair or market value. So that leads to the next point, which is that we would recommend explicitly addressing the operational responsibilities for this process, and ensuring that whoever is given that responsibility has sufficient guidance to as to when a situation should be escalated to either the pricing or valuation committees, and also has sufficient oversight to ensure that they are that the ultimate goal of ensuring a fair and reasonable price is managed appropriately by the board, by the funds board, and by the senior management of the advisor. The final implication, if you like, the final result from this is that we also believe that that funds should review their current reporting of price exceptions to the fund board. and also look at what kind of actions would be expected deriving from that. And this really is a direct result of the commentary within the order about how the fund board what kind of information the fund board received, and how the advisor subsequently explained and justified some of the questions that derived from the board. There's this whole notion of board oversight, evaluation, and what kind of information they should be getting, and what kind of questions they should be asking, is a much broader problem, a much broader issue than simply to do with odd lots, and we cover much of that in a lot of our other work. So getting to some specifics, then we mentioned in that fund valuation policies and procedures should be addressed within the whole valuation the whole valuation document. So what actually how should this be addressed? We think there's a stage in this process, a staged process to do this. So the first is clearly that the policies and procedures should define an odd lot. And this is not necessarily as simple as some folks seem to make out. We'll cover this in the next slide. But what is clear is that the definition of an odd lot needs to be both appropriate and justified for your portfolio. And this is something that is clear across all of the rules that apply to valuation, is that the approach taken needs to be appropriate and justified for the specific fund and its portfolio, as opposed to some kind of off-the-shelf set and forget type process. Having defined an odd lot clearly, then the policies and procedures should address how such a position should be priced. And here there are various ways that you can go about this. You can be extremely sophisticated about it and deploy a range of backtesting and statistical models to come up with a valuation. That we believe is entirely appropriate, but could actually place an extremely onerous operational burden on a fund's NAV calculations, which are already time constrained. So what we have recommended as a starting point to deal with this is that once an odd lot is defined, we would recommend that that position be continued to be priced at the discount to the pricing vendor mark, which pertained when the odd lot position was acquired, unless it can be justified otherwise, and until circumstances change. Let me just sort of cover that a little bit, and we also, we've covered it in the early stages of the presentation too, is that if there is a clear justification at the time why the odd lot could be marked up to a pricing vendor mark, or could be different from the price at which it was acquired, then that if you could justify that, and we would recommend that that be fully documented, that clearly you can use that different price, and at the same time, just because that discount pertained at the time that the position was acquired, doesn't necessarily mean to say that that is always going to be the same. That discount may reduce, it may increase. It may tend towards the pricing vendor market, may tend away. So circumstances can change over time, and we would recommend that this this process be continually monitored to make sure that the discount to the vendor mark remains appropriate over time. Again, I keep on mentioning documentation and writing things down, but we would strongly recommend that if any any different approach is made, or if any circumstances are deemed to have changed, then that should be fully documented. Once again, we would also recommend strongly that the process used to review these positions and the responsibility given to who will be doing that be fully documented. So just a few things to bear in mind. How often will the position be looked at? Will it be daily? Will it be every week? Will it only be when some evidence arises to justify a review? Who will do that? Is it the traders? Is it the pricing committee of the advisor? Is it the valuation committee of the fund? And what kind of activity would prompt a review of this nature? Is it? It could be a significant change in the vendor mark. It could be some observed trade activity in the which differs from the vendor mark, or some observed trade activity in an odd lot size that differs from the discount that you're applying to your current position. So there are a number of different factors that would potentially be taken into account. And here's the rub, if you like, where again the SEC is very explicit within its order that there is no standard definition regarding what constitutes an odd lot. So that's not very helpful, because that means that funds and those who advise them are really required to define an odd lot according to their own standards. What are the complications here? There are a number, and I just mentioned the one earlier about definition. The bulk of the vendors, the main evaluated pricing vendors out there, use $1 million as a standard definition of a institutional round lot. And obviously increments thereof. So anything below $1 million is deemed to be an odd lot by the vendors, and obviously if it's $1 million, with small components, increments on top of that, then potentially there is an odd lot element to that too. So is it easy to sell 1.132 million of a CUSIP as much as it is to sell $1 million? One could argue that 132 is potentially an odd lot component. So you need to take that into account. We don't think that $1 million is necessarily appropriate for some asset classes. The one that springs immediately to mind is emerging market fixed income, where some of the trading lots and some of the trading sizes within those markets are significantly lower than $1 million when it comes to what would be considered to be a standard trading lot. So if that's the case, then absolutely, then the definition can be different for those. It also, we think, depends on the size of the issue. If the issue is relatively small, the standard trading lot that would apply in those kind of cases is potentially less than $1 million. So it all goes really according to the positions that you especially hold. So deploying a simple $1 million vendor type standard, we think, is a pretty blunt instrument. and it could easily be that according to your specific investment strategy, your specific asset class positions, that might not be appropriate and potentially could and should be lower. So the other main operational complication and challenge, having defined an odd lot, is that if you as a firm have tended to use a pricing hierarchy with a vendor mark as standard, then by deploying using odd lots and using a discount approach to odd lot pricing will result in regular exceptions within day-to-day operations. So and exceptions need to be investigated, and obviously that has both a time and a resource implication when it comes to the calculation of your NAV. So that's a challenge, and I think it's something that is not an easy one to deal with. The other complication here is that is what kind of evidence requirement would one have for a set of changed circumstances. As has been seen in a number of scenarios over the past many years, the Commission do not consider some kind of set and forget process as a good idea. So the requirement to constantly monitor the circumstances of your pricing is enshrined in many of the rules that are out there. So you need to make sure that you know what kind of factors you're looking for to determine when these processes need to be adjusted or reviewed. So just a few things that we've noted here. Have you purchased enough of a CUSIP for the issue to now be deemed a round lot? Or, as I mentioned earlier, is there observable market activity out there, trades or sufficient number of reliable dealer quotes suggesting that odd lots are now worth the same as round lots, or different from the discount that you previously applied to it. The final piece here is related to materiality. So how much of this, how much does it mean to your overall NAV? Because when one looks at the order, it was the material nature of the impact on the NAV, and therefore the impact on investors, both buying and selling the ETF, that was one of the major problems. If the valuation of an odd lot position within your portfolio, either at its at a discount or at the vendor mark, does not have a material impact on the NAV, then arguably this is less of an issue. Although when one looks at the valuation requirements of the 40 Act, the materiality is not seen as an extenuating circumstance. However, I think that clearly you need to look at that, because if there is no material impact to the NAV from odd lot pricing, then it's less of an investor issue than it otherwise would be. So, in terms of the actual presentation itself, I think we can probably sum up a little bit about what we've talked about today. The first thing I would say is that all fixed income mutual funds need to address the issue of odd lot valuations. So this is not just a single firm issue. The implications that came out within the order are clearly need to be addressed by all funds to make sure that you're covered. And it is also evident that this review should encompass all asset classes. So it's not just a non-agency MBS issue, it's clearly an all asset class issue. The responsibilities of all parties in this process and the need or the requirement to escalate to a pricing committee or to a valuation committee need to be properly defined. And the oversight of that needs to be properly outlined and properly acted upon. And finally, and reporting to the reporting of all necessary information to the fund board about this obviously needs to be very clear, so that the board, if necessary, can act to deal with a situation as it emerges. And finally, once again, without flogging a dead horse, you need to make sure that it's written down, because it's clear in certainly all of the orders and administrative cases that we have looked at in the past is that the failure to document either policy or procedure or actions taken within to value certain instruments or to change valuations or to determine a different set of circumstances. If it's not written down, then you're likely to run into trouble if anybody starts asking some serious questions. So that sums up the presentation. We have around about sort of 10 minutes or so left to take some audience questions, and I know that I know that I can see that some questions have already been coming in about the various different topics that we've covered today. So I'm going to go through some of those questions insofar, and we'll answer as many as we can in the time available to us. And anything that we're unable to answer today, we will certainly try to do so in the follow-up to this webinar. So the first question is a slightly unusual one, and that is that what about odd lots that trade at a premium as opposed to at a discount? Now, I have to say we haven't really come across any scenarios of that nature ourselves. Typically, market convention is that that the odd lot is less marketable than the round lot, and therefore typically is cheaper, because dealers, traders, even funds themselves, who don't necessarily want to have that kind of smallish position in their inventory, so therefore they're willing to accept a lower price for it to move it on. Having said that, there's certainly no theoretical reason why an odd lot should not trade at a premium to the institutional mark. One could certainly envisage circumstances where that would be the case, but we would certainly argue that if you felt that it was justified to value an odd lot at a premium to a vendor mark or institutional mark, then we would recommend that be documented very carefully why that was the case, and that the rationale for doing so needs to be explained very, very clearly. Obviously, if you're pricing it higher than the vendor mark, and the vendor mark is your kind of benchmark standard within the hierarchy, then you need to make sure that you've got that fully covered. We would suggest that kind of exception would probably be a committee level issue. So either at minimum pricing committee at an advisor level, potentially your evaluation committee reporting, and probably should be monitored on an ongoing basis. The second question is one we've come across before, actually, and that is that whilst due to the nature of fund complexes who manage a number of different funds, that it is entirely possible that the fund complex as a whole owns an institutional size lot in a position, but though that broad lot is allocated to different funds, such that each fund itself has what is effectively an odd lot position within with that CUSIP. So this is something that obviously I think is a little bit tricky, because in those circumstances you would, if you wished to use the round lot price to value that odd lot position, you would need to at least be assured that that was the fair value, and that was the potential exit price for that position. And the only way that you could truly be assured of that would be if you determined that in the event that you exited that position, that all of that position, regardless of how it was allocated to each fund, would be sold at that time. So if you as a fund complex, as a fund group, are able to justify that and are comfortable with that as an approach, then arguably you could certainly use the institutional round lot price for the odd lot position within each fund. If it were likely that not the whole position would be sold, that some funds would potentially want to retain a position, whilst other funds either desired or needed to exit it, then that makes it a bit more difficult, because then you're effectively into the need to sell elements of the position and portions of the position at odd lot rates, as opposed to the full institutional size position itself. Once again, it all boils down to how much you as a firm can believe you can justify, and to make sure that that is fully documented, and especially in cases of that nature, that if sales do occur, that you're able to monitor and document that in fact it was the whole position that was sold and not just a component thereof. The third question we have here is that which market sectors are more likely to be impacted by this than others? Just to be clear, we don't recommend that funds cherry pick here. You need to make sure that your policies and procedures reflect this, regardless of what kind of asset class you have, and arguably even regardless of whether you actually undertake any odd lot trading at all. It's not a bad insurance policy to have the scenario covered within your policies and procedures, even if you as a fund are unlikely to actually need to deploy that. Having said that, there clearly are some areas that would merit some additional some additional attention. MBS is one, purely because it's the asset class that was actually involved in the SEC order. So we would certainly argue that mortgages, especially private mortgages as opposed to agencies, be given some special attention, because that's what the SEC have already looked at. So if they come knocking on the door, it could be they might end up looking at mortgages as a first set of questions. So municipal bonds, frequently trading in relatively small sizes, so where an odd lot scenario could clearly emerge, we would recommend certainly spending a bit of time and attention on that. Junk bonds, same thing, especially the smaller sized issues, and emerging market fixed income, an asset class where not only is potentially the issue size small, but also the an asset class where the trading practices, the trading standards within the market are not always well understood by some of the folks that are actually operationally deploying the day-to-day pricing function, such as the administrator or or the back office in a fund shop. The final question that I have here, I think it's going to have to be the final question, looking at the time that we have available, is what the vendors are involved here. Clearly, they're providing vendor marks, and it's the difference between that mark and what the fund is using in pricing that has caused a lot of these issues. What are the vendors doing to help? What data or analytics can they provide to assist funds with this process? Certainly to our knowledge, the vendors themselves do not provide an odd lot price alongside an institutional lot price. And there are all sorts of reasons for this. It's incredibly difficult as a vendor to deconstruct a price such that you can say, well, if it's $1 million lot, it's worth this. If it's only 200,000, it's worth that. If it's 400,000, it's worth this. So the onus again will fall on the fund itself to determine its approach to those, depending on its specific circumstances, depending on how much it owns, what its intention is to do with that, etc. So this is something that a vendor finds incredibly difficult to replicate. Or to address it. It's the myriad forms of possibilities, and so they typically default to a standard or benchmark off of which a fund needs to address its own particular circumstances. But twas ever thus. That's what the rules state and the rules imply, that you have to, a fund itself has to ensure that it's using the right price, and that right price is not necessarily one that automatically comes from a vendor. So on that note, what I would say is that we'll cover the vendor side in a little bit in my final comments, but I'd like to thank you all for attending today, and thank you for your support and your participation in the event. In terms of next steps, what we are going to do now is that first of all, we will circulate both the slide deck for this and the recording of the session, so that you can reuse it at your leisure. The second main follow-up is that Clearly, the vendors are, as I mentioned, the vendors are involved in this process. And what we are going to be doing is we are going to be going back to the vendors and producing as a supplementary report to the webinar a short analysis of what the vendors are doing today in terms of odd-lot pricing and what their plans are, and whether they offer any tools or analytics or data that will be able to help funds and their advisors to meet these additional challenges and additional obligations when it comes to odd-lot bond pricing. So you can certainly you'll certainly receive that information as part of your subscription. So on that note, I'd like to say goodbye. I'd again remind you that you can see more about the Viva package in our slide deck and on our and the links that you will receive. So this webinar is closing now, but we will have a whole range of others throughout 2017 and a range of other events as well to highlight and hopefully to review to your review to assist you to deal with some of these challenges that are arising throughout the year. So thank you very much, and we'll hopefully speak to you all soon.